In many ways, stock markets has been extraordinary in 2020. When a bear grows, it is natural to be frightened. Ditto in France. In finance, which bear markets can mean rapid losses of wealth. The coronavirus pandemic led to the fastest equipped bear market in history. The S&P 500 ex-American man benchmark took just 16 days in February to fall by 20% the standard definition. The bear also seems to have been an unusually short-lived member of species. Although economic data has been continued to deteriorate, share prices have staggered a remarkable recovery. April was the S&P 500 best month since January 1987, having bottomed at 2,237 on March 23rd. It's rallied by 27% by May 1st. Technically, that has pushed shares back into a bull market, even though they are yet to regain all these pre-pandemic losses. One reason for this mismatch between the markets and the economy is official attitudes to financial downturns has changed a lot since Andrew Mellon, American Treasury Secretary under President Herbert Hoover, argued after the crash of 1929, a downturn would preach the rootedness out of the system. Now central banks and governments respond vigorously to economic and financial trouble, and taxpayers may bear more of the burden of the crisis than investors. The sweet partial recovery is just one way in which the bear market of 2020 has been an odd specimen. It is far from clear how terms bear markets originated. Daniel Dover used the term bearskin jobber in the early 18th century. This might in turn be linked to saying about it was dangerous to sell a bearskin between catching the bear. Some speculators would agree to sell shares at the current price, even though they did not own them. To do this, they would borrow the shares, a practice known as short selling, hoping to repair the law with shares bought more cheaply. These bears then wanted prices to fall. More optimistic investors become known as bulls. Some suggest this is because bulls strike up with their horns, with bears sweep down with their paw. The traditional template for a market cycle, outlined by Charles Cameron and Herman Miskin, two economic historians, goes through 5 stages: a displacement, boom, infrastructure, crisis, and reversion. The displacement takes the forms of some new positive economic development. For example, new technologies such as the internet justify greater prosperity. Sure enough, a boom then occurs, profits rise and investors steadily become more confident. Companies borrow to expand and investors took more speculative position by saying buy shares on margin. In the boom early stages, such strategies are highly profitable, and this encourages others to follow suit. Anthropia, property is often a particular focus of speculation. The peaks of bull markets are associated with the construction of skyscrapers. At the peak, people who do not normally speculate are done in. In the late 1990s, investors became day traders in technology stocks. In the early 2000s, more people became homeowners to profit from rising prices. Because asset prices looking higher on conventional measures, optimists make up new ones to justify them. Skeptics are dismissed as dinosaurs who just don't get it. Eventually, the boom leads to inflation as companies can compete for scarce raw materials and workers. Central banks respond by pushing up interest rates. First, this makes little difference. Eventually, something happens to determine confidence. It can be hard to pinpoint what. It may simply be that a few investors decide to crash in and take their profit, and once prices stop rising, the machines start going into reverse. As asset prices fall, those who have borrowed on margin or with borrowed money are forced to sell. Banks become reluctant to lend, nervous about the value of collateral. They ask some borrowers to repay. Nervous buyers retreat from the market as the prospect of juicy gains becomes uncertain. So it is difficult for forced sellers to find new buyers. The fall accelerated. Often a scan is uncovered. Booms are an ideal opportunity for what J.K. Ballance, a Canadian-American economist, called the Barzo fraudulent schemes that allow insiders to buy the public, or the problem may simply be the executives at the company are revealed to have taken far more risks than was produced. The depression brought the collapse of the utility empire built by Samuel Insull, another utility group Enron, imposed during the bear market of 2002. Some parts of the temper did fit the condition of 2020. The bear market followed one of history's longest bull runs, which began back in March 2009. The displacement that started the boom was central bank decisions to cut interest rates to a new low and to use quantitative easing to force down bond yields to support economic growth. Even since, one of the most common arguments for buying equity was that the yield on government bonds and cash were so low. As in previous bull markets, equity valuations rose substantially. Robert Shiller, a Nobel Prize winner economist, compares a valuation measures which averages profit over 10 years, called the cyclically adjusted price earning rate. At the start of 2020, the cap for the American market was 31. That compared with a historic average of 17, the peaks of 44 at the end of 1999 and 33 in August 1929. When shares trade at a higher multiple of past profits, the implication is that investors expect future profits to grow rapidly. Even before the pandemic, the trend was not encouraging. According to the Bureau of Economic Analysis, American corporate profit was flat in 2019. Furthermore, the world economy slowed in the face of the Sino-American trade war. Global growth was just 2.4% last year, the weakest since the financial crisis 2007 to 2009. Commodity prices, which usually surge at the end of boom, drifted down after May 2018. Another sign of impending trouble was in the bond market. Usually, the cost of long-term borrowing is higher than that of the short-term finance. Lenders demand more for locking up their money, but sometimes short rates are higher. A stick known as the invested yield curve, which often occurs before a recession. Parts of the yield curve inverted in March 2019, and the phenomenon has reappeared the various types since, most recently in January 2020. So, share price must have fallen even without the coronavirus. But in other respects, the coronavirus crash does not fit the temperament neatly. There was no inflationary surge at the end of the boom. The personal consumption expenditure index, the inflation measure targeted by the Federal Reserve, rose by just 1.8% in the year to January. Just before the stock market declined, the Fed was cutting interest rates, not increasing them, even before the pandemic started. Another difference in the scale of authorities' response in America, Congress approved $3 trillion of tax cuts and spending increases, while the Fed has cut interest rates to nearly zero and expanded its asset buying program. Even agreed to buy risky higher-yield corporate bonds. In Britain, the government is guaranteeing loans to small business and paying 80% of wages of furloughed workers. This measure has brought out market sentiment and has evidence that the number of cases and deaths from the coronavirus may have been peaked, as well as a rally in equities. Higher yield bond market has picked up. Of course, the enormous support given by the authorities has been designed to offset the economic damage caused by the attempts to contain the disease. Around 30 million American workers have signed up for unemployment benefits in 6 weeks. The previous record of a 6-week stretch was just under 4 million. In 1982, the European Union's GDP fell by 3.5% in the first quarter of the year, which included only a few weeks of lockdown. These extremes make valuations hard for investors to assess. It's as if someone turned on a scalding hot shower and then reacted by emptying a bucket of ice over themselves. There was a few historical parallels. Outbreak of the First World was also a genius struck by the authority quickly closed stock markets, so it is not a useful basis for comparison. Furthermore, wars usually involve a massive increase of individual activities to produce armaments rather than a current lockdown. Usually, bear markets tend to be done out of a foreign assets prices interact with and exaggerate economic downturns. The classic example was depression, which was linked both to widespread bank failure and the stock market crash that began in 2009. The collapse of property prices and the handing sector in 2007 and 2008 led to a recession across the West. But the revision stage of the bear market temperament may be yet to come. The authorities have stopped the road on the Wall Street, but Main Street is still suffering. Several quarter figures may show some economists shrinking at an astounding rate of 20% or more. The IMF, which expects global GDP to decline by 3% this year, said the magnitude and the speed of the collapsing activity is likely anything experienced in our lifetimes. The impact of companies will eventually be served. SP, a rating engine, estimated that the default rate on the riskiest Europe bond will jump from 2.2% to 8% this year. Firms are slashing dividends. Real Dutch shares has cut its payout for the first time since the Second World War. Robert Buckland of Citigroup estimates the European profits and dividends will fall by half this year. In 2019, American companies spent $729 billion on buying back their own shares, an important source of support for the markets. Many have suspended buybacks, including the 8 big banks, demand global systematically important by bear community on banking supervision. So, although the origin of the bear market may be unusual, but the support from central banks and the government has been substantial. The same feedback process seen in another downturn could yet occur, but that may rise and investors may lose their enthusiasm for risky financial assets for an extended period. In the wild, bears are likely to run away when they hear a lot of noise, so perhaps authorities have done enough to scare this one off, but with most countries still in lockdowns, we are unlikely to be out of the wood yet.